Hi everybody, welcome back to 10 Minutes with Griffin. I'm your host, Griffin Bridgers. For today's episode, episode 151, I'm going to introduce a concept that kind of builds on some of the material I've introduced in the past, looking at the effective estate tax rate when you compare it to capital gains that are avoided. But we're going to layer that in now and add in also the GST tax, the generation skipping transfer tax, and look at how effective rates in the estate planning world aren't just gimmicky, they could be used for great drafting and great planning to pay estate tax in a way that might generate more tax savings elsewhere than might have otherwise been anticipated. Now, as always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. Now, as a fair warning, what I'm going to discuss today is highly conceptual. So this is really part one of a series where I'm going to dive into the numbers and some materials on drafting, either in video or written form, in follow-up presentations, really just building on what we're going to examine here. Just because formula clauses are good in estate planning, but we're going to look at how we can take them from good to great. So with effective rates, this is usually only something that's considered within income tax itself. Because with income tax, there's a number of progressive rate brackets, and each bracket only kicks in when your taxable income reaches a certain level. And when you take into account that those rates stair step up, there's an averaging effect that you can take into account, really dividing just your total tax by your total tax by your taxable income to come up with an effective tax rate. Now we can also apply this to the estate and GST tax, which typically, based on the brackets, are going to be applied as flat rates. And because there's just a 40% rate that applies, it seems gimmicky there, but it's actually not. What we're going to look at today is the theory that you can actually compare effective rates across the estate, GST tax, and possibly capital gains tax for any capital gain we avoid through a step up in basis, so that we can have more effective planning for GST and basis step up purposes. In other words, could a ticket to entry for GST and income tax savings be the payment of estate tax at a lower effective rate? And what we mean here is that our effective estate tax rate is always going to be less than 40% because we have an estate tax exclusion, which is currently 11.7 million. So because the estate tax only kicks in over and above that amount practically, our rate that we effectively pay in estate tax as a percent of our estate is usually going to be much less than 40%. And we'll see how this is used in a minute. For the time being, I wanted to provide a simple example where we have a taxable estate of 14.2 million, and the first 11.7 million of that isn't subject to estate tax because of that exclusion amount. So what that means is we have 2.5 million of the taxable estate that's subject to estate tax at a rate of 40%. And it could also be subject to GST tax at a rate of 40% upon the earlier of a direct skip, a taxable termination, or a taxable distribution. We'll get into that type of analysis in a later discussion, but for the time being, our estate tax is simply going to be 40% of 2.5 million, or 1 million in this case. So we have this $1 million estate tax on a taxable estate of 14.2 million. So the percent of our taxable estate that consists of estate tax is really just 7.04%. So that's really our effective estate tax rate. We've only paid out 7.04% of the taxable estate in estate taxes. In other words, that's $1 million of that, and 13.2 million of that taxable estate is still going to go on to the heirs after payment of that estate tax. You're not paying out 40% of the estate in tax. You're paying out just over 7%. Now, why is that useful? Well, we can use that the effective tax rate in formula clauses. especially when we're looking at GST tax planning and basis step-up planning. And really the theory here is that within a trust, to avoid wasting GST tax exemption, or maybe even estate tax exemption, many non-spouse beneficiaries are given a general power of appointment over some or all of the trust assets that's equal to their unused GST tax exemption. Sometimes that's baked into the trust, and sometimes a trust protector is given the authority maybe to amend a power of appointment to achieve this optimal outcome. But typically, when we look at a formula, it's only good because it only looks at the unused exemption and it gives you a general power of appointment up to that threshold in order to maximize the use of tax exemptions. But what if we could maximize this by applying more by formula to a general power of appointment than the amount of the beneficiary's remaining exclusions? What would happen there, especially in a case where maybe the estate tax exclusion is less than the GST tax exemption, is that you'd have a seemingly unnecessary estate tax. But as we just saw in the last slide, the overall cost of the estate tax is usually less than 40% when you take into account the effective rate. So ultimately, we can use that effective rate to look at the fact that that seemingly unnecessary estate tax might actually be less than, for example, a GST tax that we avoid when we compare the two effective rates there. Similarly, we might have an estate tax that we're paying that might actually be less when we look at the effective rate than the avoided capital gains tax from a step up in basis when we compare the effective rates. Now we're a little bit beyond the numbers here, but what I'm going to present is maybe in that last example back here, going back to the numbers, is what if instead of having a beneficiary who had a general power of appointment over 11.7 million of this trust here, that beneficiary instead had a power of appointment over all of it, a general power of appointment over 14.2. You still have a $1 million estate tax, but if the GST tax you avoid is greater than $1 million, that might be worth it. Similarly, if the capital gains tax you avoid due to a step up in basis here is greater than $1 million, it might be worth it. And that's the entire premise of today's discussion. So, if you're saying, I don't get your theory still, show me the numbers, that's really what I'm teeing up for a later episode here when I can dive into a better example. Given the time I had this morning, I couldn't really come up with a solid example that we could use with great utility across all of these, and I may have to just break it out by GST tax versus income tax. But if you allocate more than $11.7 million worth of general power of appointment in a trust, that'll create an estate tax to the beneficiary, but the more in excess of this amount you allocate, then the closer you can get to a break-even point where you compare those effective estate and GST taxes across the board and the effective capital gains taxes that are avoided across the board as well. Now, in our current environment, I realize that we run the risk of that estate tax exclusion going down due to congressional action in the coming months or coming year. So, this may not be an optimal treatment if that exclusion goes away. This may be less relevant, but it could still be relevant, especially for drafting purposes or even for purposes of acting as a trust protector or trust advisor. However, if portability elections don't go away and there's still a large number of these unused deceased spousal exclusions hanging out there, then that's an area where this type of planning could really be useful as well. Now, this strategy is not without its issues. The biggest one being is that we're forcing an estate tax to be paid maybe by a beneficiary of a trust. So liquidity becomes a concern. If we have an overfunded general power of appointment formula, obviously that's going to generate estate tax, and there has to be enough liquid assets either in the trust or in the beneficiary's own estate to pay that tax. So you might have to look to life insurance and other types of liquid assets. And when you look at that, there may be assets like highly appreciated real estate that are highly illiquid and can't necessarily be sold to generate the the estate tax amount. But with the step up in basis, that may not be as much of a concern. But regardless, we have to take into account liquidity as a non-tax consideration here. And if we can get over that hurdle when we compare the liquid assets in the trust and the liquid assets in the taxable estate to look at the source of this unnecessary estate tax we're paying, then that may create a good solution here that we can overcome this hurdle through. But either way, stay tuned for more on the numbers and how we can use effective transfer tax rates to really look at the holistic picture of planning outside of a vacuum. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. Thank you for listening to this episode of 10 Minutes with Griffin, and I look forward to seeing you in the next one.